US jobs report raise hopes of soft landing. September belonged to India's two-wheelers and why Walmart continues to shine. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. First of all, a big thank you. A big thank you to all of you for all the support that you've provided me. All these in the last 3 years. The 100th episode has been an absolute hit, and I've received an outpouring of love from all of you. So, I mean, a big thank you. And I really enjoyed the show. I really enjoyed shooting the 100th episode special with Dr. Ryan Lamond of Neovision Wealth Management. So if you haven't checked it out, do check out the episode. And so far, for those who have checked out, I'm just so glad that you all loved it. So there'll be more interviews with top fund managers down the line. But this week, we are back to our normal format. So you will get to hear me talk for the whole show. Not sure whether, I'm sure you're used to it by now after 100 episodes, of which, 99% of the time it's just me, so I'm sure that you're used to it. But don't worry, like I said, there will be more interviews with the top fund managers down the line. For now, ladies and gentlemen, let's all rejoice at the blockbuster week for the US economy, thanks to some solid positive economic data, especially the September jobs report. There is, however, the good news comes with a caveat. There are escalating global geopolitical tensions. I'm not sure whether you've read the news yet. Obviously, I'm sure that all of you have been on top of the news, and it is not good news, unfortunately. So, escalating geopolitical tensions, they're continuing to, basically continuing to be alarmingly escalating. Let me put it that way. Geopolitical tensions have been continuing to be alarmingly escalating. And this was on investors' minds for most of the week. As such, the celebrations were very muted until Friday, of course, when you got the jobs report, and then it just skyrocketed. When the dust settled, all three indices ended in the green, albeit just about. I mean, you had the Dow and the Nasdaq, gaining up to 1.1%, and the S&P 500 eking out a 0.2% gain. So, if you actually take a look at Friday, you wouldn't think that it was a blockbuster, spectacular week for US markets, but that was not the case. These escalating geopolitical tensions that I've been talking about, they were definitely on investors' minds as well. But in fact, actually, actually did happen was Friday's jobs report was what helped all three indices get into the green. Until then, if it weren't for the blockbuster report, things would have been pretty grim for the markets. But you had Dow and Nasdaq just gaining 0.1%, S&P eking out 0.2%, and most importantly, S&P has now set a 4-week win streak for the first time since mid-May. So the question remains: after 4 days of subdued trading, thanks to geopolitical tensions, what was so special about Friday that made the markets jump with joy? Quite literally, they skyrocketed into the green. To find that out, let's head to our first segment, Doctor's Weekly Snapshot. And bam, 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 some random music. There's no music here. We're already in the first segment. So, ladies and gentlemen, welcome to the Doctor's Weekly Snapshot. I know it must be feeling weird, right? I mean, episode 99 was just Dr. Dissects, where I just talked about Uber. And then episode 100 was an interview. I'm sure you must have forgotten the format. This is short in one go. We don't have any transitional music. We just want to give you straight up. I don't want to keep. I want to get straight into the point and without any sort of interruptions. So remember, 3 segments: weekly snapshot, goes home, Dr. Dissects. Yeah, don't forget, the format hasn't changed. It's just that we have an Instagram channel now. Apart from that, there's nothing much change. So we are in the Doctor's Weekly Snapshot, and like I said, guys, what a week it was for the US economy. With a fresh earnings season kicking off next week, the positive economic data could not have come at a better time. Let's start with the blockbuster jobs report. I mean, that was the elephant in the room for the week. That is exactly, like I said, what took the markets from what would have been a negative week to a positive one. So let's just start with the jobs report, an area that was of particular concern, by the way, for the Fed, and one that prompted Powell and Co. to actually undertake a larger than expected 50 basis point cut at the first instance of a monumental rate cutting program. So remember, when Fed did take 50 basis rate cut, it did say that while the economy was in good shape, labor markets were the ones that were starting to be a bit concerning. All that was put to bed by the September jobs report. Expectations were that the US economy would add 150,000 jobs in September. The reality blew those expectations out of the water as the US economy ended up adding 254,000 jobs last month, making it the largest increase since March of this year. The unemployment rate, which had been slowly creeping up in the last few months, actually came down, which is a good sign. It came straight back down to 4.1%. It was hovering around the 4.3% mark, if you correctly recall. Excuse me, and now it's down to 4.1%. The icing on the cake was the news that hiring in the summer was actually not as bad as expected, as evidenced by the 72,000 additional jobs that were added in July and August combined, which essentially means there were 72,000 more jobs in July and August than what the July jobs report and the August jobs report suggested. So, all in all, hiring was strong, unemployment rate was weak. So, it is it was, and no wonder then that markets were rejoicing with joy, and no wonder then that investors are now really happy about the state of the US economy. Now, if you recall correctly, July and August jobs report, there was the jobs were keep on being added. I mean, they were not being added at the rate that people were expecting, but it was still being added. But there was a lot of debate surrounding the actual jobs being added, as in there was concern among investors that the labor market is holding its ground only because of government and healthcare jobs, which tend to be immune from economic shocks. So basically, the labor market, according to investors or according to markets, according to a certain section of investors, was essentially sort of not reflecting the real state of the US economy. It was the government and the healthcare jobs which tend to be immune from economic shocks that were holding up the labor market, according to a certain section of the investors. And that is what led to some volatility in the markets. While that was the case in September as well, robust hiring was actually seen in economically sensitive areas such as bars, restaurants, and constructions as well. So, not just government and healthcare, this time, those economically sensitive areas were also, economically sensitive areas also saw hiring. So, it's simply because consumer spending on burgers, drinks, and travel remains strong, which suggests that fears of a post pandemic slump in spending may have been overdone. Wages also saw a jump, which is again fantastic news. Average hourly earnings rose 4% year over year. It was the strongest increase since May. And it was also a positive that wage growth came above inflation, which rose 2.5% year over year in August, thereby bringing some relief to price pinching consumers or those consumers who were wary of inflation. Remember, consumer spending was under threat of taking a hit because consumers were becoming more price conscious, rightly so. But given the fact that wage growth has now trumped inflation growth, it really does bode well for the US economy again. Jobs data was not the only piece of good news, although it had the most impact. On Thursday, we got the ISM services data, which came in at 54.9%, and it was the highest reading since February 2023. It also meant that the services sector has now expanded for 3 consecutive months, which kind of explains why there was a lot of hiring in sectors such as bars and restaurants. Finally, the event that was starting to threaten Fed's inflation battle, the massive strike of dock workers at US ports in the east and Gulf coasts of the US, the first ever strike since 1977, finally came to an end after just 3 days when the International Longshoremen's Association, ILA, the union representing the dock workers, reached a new tentative deal. Dock workers would now see their wages climb a whopping 62% year over year over 6 years as part of the deal. Given that they were demanding a hike of 77%, which is insane in my opinion, I think the deal is a big win for all parties, especially since a prolonged strike could have caused some serious damage to the holiday season. I mean, in all honesty, guys, I'm going to be very honest here, and I'm going to be very candid here. I actually question the rationale for the strike. Because if you actually think about it, dock workers already earned more than 100K a year, $100,000 a year. So, what was the rationale behind 62%, 77% demand of wage hike is something that I found it to be absolutely insane. Just my opinion. I'm pretty sure I'll hear a lot of criticisms over it. I'm pretty sure I'll be called a greedy capitalist or whatnot. But hey, I'm not the shipping company. I'm just thinking if you're earning more than 100K a year, I'm just not sure why you would ask for a 77% wage hike. But hey, my point amongst all of this as an investor is that as long as the strike is over, I really don't care. I mean, fantastic, good for you. You got your 62% wage hike. Really happy when people get paid more. When especially without causing much disruptions, it's done. We've already seen a lot of disruptions in various forms of strikes over the years. So I'm just glad that this whole thing is over inside 3 days, inside 72 hours. Because put simply, if this had prolonged, then it would have been a real problem, especially since we are just around the corner of holiday season in the US and retailers were already starting to issue warnings. So just absolutely glad. I'm not going to question the rationale. I mean, in my head, I question the rationale, but I'm just not going to, have an open debate over here. Criticism, welcome. Don't really care. All I'm saying is, I just don't understand when you're earning 100K a year what's the interest for 77% wage hike. But hey, that's just me. I'm just glad the strike is over. Happy for the dock workers that they've gained a 62% wage hike. All the demands, most of their demands were met, and we move on. Right. And we move on to what? To the basically, we're going to dissect everything that's just happened. A lot of positives to take here. Markets rightly reacted to the positive news as the paradise called soft landing still very much remains on the cards. Soft landing, Goldilocks economy, no landing, all of these are terms that you can very well see on Wall Street Journal, Financial Times, and CNBC, all of the and Bloomberg and all the other media channels. So hey, why should the stock doctor be left behind? Huh? So yeah, the soft landing, paradise called soft landing, very much remains on the cards. And I would actually go to the extent saying that it's very well within reach now. Having said that, I'm not somebody who's only looking at the positives. It was not all good news because while services sector expanded, manufacturing sector continues to be a worrying sign as it contracted for the sixth consecutive month, with the September manufacturing PMI coming in at 47.2%. And this was clearly reflected in the jobs report as employers in the manufacturing, transportation, and warehousing sectors did reduce their headcount, albeit at a modest rate. Moreover, data from the Labor Department released earlier this week showed that people were less inclined to quit their jobs for new ones, as evidenced by the share of workers quitting their jobs each month falling to its lowest levels in more than 4 years in August. So consumers continue to be wary. They continue to be wary about the labor market, which suggests that investors shouldn't get too carried away with the September jobs report. In other words, can this be sustained? Can this blockbuster jobs report, can this momentum in the labor market be sustained? That's the question that investors, as us investors, should be asking. Bottom line, it was a fantastic week for the US investors, at least from a US economic perspective. Jobs report confounded everyone, including the doctor himself, in a very positive way. And the services sector expansion suggests that the US consumers continue to spend and spend and spend. There was also positive news for retailers, as in addition to strong consumer spending, the dock workers' strike in the Eastern Gulf Coast ended much earlier than anyone anticipated. All of this sets up a perfect foundation for earnings season, which officially kicks off with the big banks next week. In fact, next Friday is when the big banks such as JP Morgan, Citibank, all of them start reports. So I can't believe time's already flying. We're already into the next earnings season already. However, it's not, I mean, given all these, despite all these positive news, let's put the champagne on ice, guys, because it's not all rosy as far as investors are concerned. The geopolitical tensions, I keep saying, especially now that Iran has entered the fray, remain extremely high, and investors really need to be on full alert. For the first 4 days of last week, they were on full alert, just goes to show we are nowhere close to being out of the woods. In the coming days, there is every possibility that this risk, the geopolitical risk, would ratchet up, given that there are talks that Israel could attack Iran's oil facilities, which would lead, according to Goldman Sachs, basically it would lead to crude prices skyrocketing. Goldman Sachs even has a number on it. They predict that oil prices could shoot up to around $20 per barrel if Iranian production sees a hit. For now, the US markets have been surprisingly immune to these geopolitical tensions, given that they have been enjoying the solid economic data and the fact that the Fed may not have to be as aggressive when it comes to rate cuts. But how long can they possibly ignore these tensions remains to be seen. It's good to enjoy good news. It's great to enjoy good news as investors. We must absolutely not celebrate to an extent that we forget everything else, though. And today, the geopolitical risk is simply too big to ignore. As such, toning down the enthusiasm may be a good idea. On that cautionary note, as I take a sip of my water, we're now heading to the next segment. The doctor goes home. Smart Water is not advertising this, by the way. I'm just just drink it from here. Okay, now we are in the Doctor Goes Home segment. A new month, literally 6th of October. I'm looking at my calendar. 6th of October, new month means yet another segment of discussing India's auto sales numbers. And it's good news for consumers because the discounts are flowing this festive season. And even though the discounts are flowing this festive season, there has simply not been any uptick in demand. So that's the worrying sign for automakers. Great news for consumers, though, discounts on your dream car. That's the key message, at least. So basically, the message that the automakers gave in September is we are giving you discounts, but unfortunately, why are you not buying? Simple as that. That's the key message from Indian automakers as car sales declined for the third straight month in September. After a decline of 2.5% year over year in July, a 1.8% year over year decline in August, September saw sales decline to the tune of 1 to 2.5%, coming in at a range between 355 and 360,000 units. The intriguing part is that the monsoon effect, I mean, that's just my word, by the way. I mean, it's my definition, nobody else. I mean, I'm going to claim it. The monsoon effect essentially basically means we had an above average monsoon, a better than expected monsoon season. Everybody expected auto sales to basically spike up, but so far this monsoon effect is yet to rationalize, is yet to actually play out, not rationalize, yet to play out in the open. Early days, we get still not into the thick of the festive season yet, but that's the message so far. Let's get to the top car makers individually now. Excuse me. India's largest car maker, Maruti Suzuki, saw its year-over-year sales decline, domestic sales decline 4% year-over-year in September, coming in at a little under 145,000 units compared to a little under 151,000 units during the same period last year. Exports were the saving grace, so much so that overall, Maruti had a positive September sales-wise. While UV sales registered a year-over-year growth of 4%, UV as in utility vehicles, the sales of the company's mini segment and the compact cars saw significant declines. The second largest car maker, Hyundai Motor, saw its sales drop 10% year over year, with total sales coming in at a little over 64,200 units. Both domestic and exports registered a decline in growth in September, with exports in particular being a major concern, following 25% year over year. The management announced that SUVs now account for 70% of the company's overall sales. The timing of these declines, honestly, as far as Hyundai goes, could not have come at a worse time, especially since the company is gearing up for what is expected to be India's biggest ever IPO, valuing the company's India business unit at, get this, $19 billion. Of course, the Stock Doctor plans to bring you guys a dedicated Hyundai IPO segment in the next couple of weeks, so that it's not investment. I don't give investment advice, but at least you get some information for you to look into whether you want to buy into the company or not at the IPO. Of course, I'm going to give you a dedicated Hyundai IPO segment in the next couple of weeks, simply because at the end of the day, I want you guys to understand why, in my opinion, this is an IPO you absolutely cannot miss. Remember, this is not an investment advice, just an opinion. I am more than leaning towards investing in Hyundai IPO. Just a disclaimer there. But again, I don't give investment advice, but I will give you my opinion on why I think this is an IPO that investors simply cannot afford to miss. Moving on to Tata Motors now, TAMO, which is seeing the ground underneath it crumble, metaphorically, of course. Ground's fine, but sales-wise, it's not good news. For the first time in ages, Mahindra and Mahindra beat TAMO in monthly sales. Before I move to M&M, which is quickly becoming my favorite automaker, TAMO was my first. Sorry, TAMO. But before I move to M&M, let me first talk about Tata Motors. The company saw an 8.3% year-over-year decline in its sales, driven by factors such as slow customer demand and seasonal variations. As a response to this shock, the company did something that very unusual, which is Tata Motors now plans to advance the annual maintenance shutdown of its passenger vehicle plants in order to align the production with demand, and also to correct the inventory before the end of 2024. Tata Motors is the first automaker to do this, given that automakers typically undertake such shutdowns in December. It is indeed a worrying sign, especially when you consider that not too long ago, the company was targeting Hyundai's number two spot, and now it has lost the number three spot. The demand for its latest models, such as Curve and the higher range of Nexon EV, continues to be strong, according to the management, but it simply has not translated to sales. It simply this is a very worrying trend for Tamo, and I would, simply put, as a Tata Motors investor, I am definitely concerned, and I would definitely be watching out for what the company plans to do in order to mitigate the slump that it seems to find itself in. Finally, I moved to Mahindra and Mahindra, which is, again, like I said, fast becoming my auto stock. And honestly, guys, I thank God that I invested in this name, because the company is currently the hottest name among the automakers. When everyone else is suffering, Mahindra and Mahindra has been on the rise. In fact, no pun intended. I mean, no pun intended. Yeah, no pun intended. Mahindra Rise is actually their basically their new logo. So M&M has indeed been on the rise. So no pun intended there. In September, Mahindra and Mahindra's SUV sales surged 24% year over year, which helped the overall sales to grow 16% year over year. I mean, these are impressive numbers, especially when the overall market is suffering. And the demand shows absolutely no signs of abating. Its latest model, the Thar ROX, that's ROXX, received 1.76 lakh bookings within the first hour of availability, making it the highest first day booking figures for any M&M product ever. Keep in mind that this model was brought out because the original Thar was not a hit among everyday consumers who preferred, especially those consumers who preferred just daily use of family trips. I mean, this is an off-roading beast. So clearly, it was not a hit for those who preferred just daily use of family trips. So the company took the rugged design of the original Thar and tweaked it for a wider audience, and that has resulted in 1.76 lakh bookings within the first hour of availability. The ROX is also priced very competitively. It's priced competitively between 13 and 20 lakhs ex showroom. I mean, remember, guys, Indian automakers are suffering a sales decline. So the surge in demand for M&M is an outlier, and boy, oh boy, it's an outlier by a huge margin. No surprises then that the company's stock has gained, get this, 11% in 1 month and is up a whopping 77% year to date. And this is even before it launches its own EV models. Imagine what happens to Tamil then. I don't even want to think about it. Let that sink in, by the way. Okay, that was the four-wheelers. Let's move to the two-wheelers now, who have painted a completely different picture. I got so excited my laptop fell apart. Who have painted a completely different picture compared to the car maker. I got so excited with the hand movements moved, didn't realize my laptop was there. Well, this is the point. When you're recording, you get to see all this craziness. Hero MotoCorp saw its sales surge 19% year over year, with both domestic sales and exports registering impressive growth rates. When I talked about Hero's July sales on episode 95, I did say that I wouldn't read too much on the weakness then. Rural India has awakened thanks to better than expected monsoon, and this is clearly seen in Hero sales in September. TVS Motor continued its growth trajectory, with sales jumping a whopping 22% year over year, with domestic sales being the primary driver. The company, despite registering a 15% year over year sales in its EVs, lost its number two spot in electric two-wheeler sales to Bajaj Auto. Speaking of Bajaj Auto actually saw its sales jump 20% year over year in September, with two-wheeler sales registering a 22% year over year growth. Both domestic sales as well as exports contributed to the overall growth. Bajaj Auto is turning out to be a serious competitor again, and I kick myself every single day for not investing in it in its early days. I'm still looking into the company to see an attractive entry point, but as things stand, it doesn't. The stock's gone too far, too fast. I mean, it's becoming a serious competitor again. I mean, the stock's up 76% year to date. As such, I think I'll probably have to wait for a meaningful pullback before getting into this one. It's honestly, this is an oversight on my part. Should have been tracking it, did not. That's my bad. But for those of you who have invested in Bajaj Auto, well done. Royal Enfield also had some good news to celebrate, as sales jumped 11% year over year, with exports registering a growth rate that was nearly double the growth rate of domestic sales. Finally, an investment that I'm beginning to again question, but I will continue to remain invested, and I do this because it keeps me up at night sometimes. Ola Electric. I did invest in the IPO, and now I'm starting to question it, but I do believe in its long-term trajectory, and so I'm going to hold on to my shares. But believe me, it has not been a great ride since the IPO days. It continues to suffer, and I'm just simply not happy with the company's trajectory right now. The company experienced its lowest monthly retail sales in 11 months, and its market share dropped to 27% in September as the likes of Bajaj and TVS are catching up at a rapid pace. I mean, how do you, oh my God, how on a market, in a market environment where literally is support which literally is supporting the two wheelers, I don't know how you mess it up, but turns out you can mess it up. And I'm looking at it, I'm watching at it, I'm still in the green, but I am definitely looking at it, and to see whether I trim, or whether things change. I'm also interested to see their latest discounts. They call it boss. Don't care about the name, just want you to ramp up the sales. But I am interested in how the discounts offered by Ola fare in the festive season, in the thick of festive season, and maybe then I'll take a step. But you guys will know. I'll keep you posted I'll keep you posted for sure. All I'm saying is there should be no surprises if you actually look at Ola's stock trajectory. After a blockbuster post IPO jump, shares have just simply fallen off a cliff. At one point, they were 100% up after IPO. Now they're up about 30%. It's whoever bought there, my condolences. Bottom line, the festive season so far decidedly belong to the two wheelers. I mean, I got so excited, whacked the laptop. I mean, this just goes to show how much the two wheelers have done. I mean, it's caught me off guard. And, obviously I didn't do it for dramatic effect. It was accident, but you get the point. There is no two ways about it. September belonged to the two wheelers. Hands down, the Indian consumer has clearly shown his or her preference. I mean, you are seeing double digit growth across every single major two wheeler player. And the traditional two wheelers are breathing down the neck of players such as Ola. As far as car makers are concerned, the main stretch of the festive season would be very, very crucial. And they are very well aware of this and are resorting to heavy discounts to boost their sales. Barring Mahindra and Mahindra, every other major car maker needs to have a blockbuster October, and they're simply leaving no stone unturned. No surprises then that the likes of Maruti and Tata Motors are resorting to heavy discounts to bump up their sales. In addition, car makers are introducing several new models to ensure that they attract consumers. Again, I don't know whether you've seen Kia's luxury EV9, which costs about 1.3 crores. It's an absolute beauty, but you would have to, cough up a 1.3 crores for it. But it's a beautiful, it's a beast. Whether all of these moves by the car makers will pay off remains to be seen. October has never been this crucial for some of India's major auto giants. As investors, we can only hope that the spooky month doesn't come to haunt the very said auto giants. As I take another gulp of water, we are now heading to the final segment, Doctor Dissects. I don't know why I gave you the crazy music in the first. I should have just taken a sip of water, and then you would know. Oh, segment's over. When is thirsty? So yeah. Anyway, we are now heading to the final segment, Doctor Dissects. You can see all the goofiness now that video is available on YouTube. You can see all the goofiness out there. I've been meaning to show it, but I thought, well, I'll wait till 100 episodes and then show you all the goofiness of recording this. Don't have a producer, guys. I am my own producer, and clearly the goofiness is allowed. Welcome, right, to the Dr. Dissect segment. This week, I dissect the retail giant Walmart, ticker WMT, especially after some interesting developments came out of its most recent second quarter earnings report. And I want to start with an AI flavor. It's a miracle. It's a miracle. I've been recording for all this while, and I still have not talked about AI. How can I record a show without talking about AI, right? So I've got to start with an AI flavor. And Walmart, of all places, is where I begin to talk about AI. Let that sink in. I'm not crazy. There's a reason why I'm saying this. There have been a lot of doubts, okay, surrounding the value proposition of generative AI, especially given the amount that companies are currently spending on it. I have gone on a rant for I don't know how many episodes. You saw Dr. Lemon's take on it 2 weeks ago, where he basically said the same thing. This is not AI, it's inference. All of these valid points. So there have been a lot of doubts surrounding the value proposition. While the technology continues to remain nascent, all I can tell you is when it comes to Walmart, And if you look at Q2 results, generative AI did play an influential role. Given the weakness seen in consumer confidence in the US, and given that the US consumer has become more price conscious, user experience has become a key differentiating factor for retailers. Using generative AI, excuse me, Walmart did manage to boost the overall user experience, especially in its e commerce business. One example is how the company made its cross category search more effective with the help of generative AI, leading to improved visibility of its general merchandise items. The improvement led to a higher rate of impulse buys, which translated to narrowing losses for its e-commerce business. Obviously, when the more people are tempted, clearly there are a lot of impulse buys that take place. I've done a lot of impulse buy. I was watching WWE. Yes, ladies and gentlemen, I'm a fan of WWE. I was watching WWE. I got so excited by one of the matches that I went and bought a T-shirt. Do I regret it? Maybe a small part of it does. But hey, went on to buy it, impulse buys. And because using Gen AI, Walmart has somewhat figured out how to actually I don't know how to create impulse buy, how to induce impulse buys. I don't know how to put it, but anyway, that's what's happening, and it actually led to narrowing losses for Walmart's e-commerce business. Fantastic. Another instance of how Gen AI played a crucial role was in improving the company's overall product catalog, which boosted both the overall experience and enabled the company to be more efficient with its inventory management. During the most recent earnings call, management mentioned that they had deployed multiple large language models to improve over 850 million pieces of data associated with the product catalog. A task, according to management, would have required nearly 100 times the current headcount if it had to be completed in the same amount of time manually. More features using Gen AI are in the works, including a new shopping assistant, which is trained to answer questions like which TV is best for watching sports. I'd be curious. I watch a lot of sports. I'd be curious to see which TV is best for watching sports. I mean, the last time I talked about Walmart, I did talk about how the company remained resilient even in the face of a challenging macro environment. Obviously, macro environment is quickly, rapidly changing in the US, but for now, I'm just saying, in the most recent quarter, environment was still challenging. But the most recent quarter actually gave us more evidence on how the company has been able to stay resilient during these challenging times by leveraging generative AI and automation effectively to enhance user experience and convenience. The end results has been in better inventory management, higher sales growth, and a better performing e-commerce business. That's the first takeaway that I've seen. The second takeaway, as far as Walmart is concerned, I highlighted how the company's India business Flipkart could be a potential catalyst for the company. During the most recent second quarter, in addition to Flipkart, the likes of Walmex, its Mexican business, and its China business demonstrated strong growth, which subsequently resulted in a strong performance from by its international business. More specifically, the international business saw its net sales come in at $29.9 billion, translating to a year-over-year growth of 8.3%. Operating income also delivered a strong growth of 15.7% year over year. International e-commerce sales experienced improved margins and narrowing losses thanks to increased penetration across the company's various markets. Finally, driven by Flipkart and Walmex, the company's advertising business registered a year-over-year growth of 23%, contributing to the 26% year-over-year growth of the overall advertising business during the quarter. This is on top of the 24% growth that the advertising business registered in the first quarter. While Walmart does not provide a detailed breakdown of each of its international markets, management did mention that the Flipkart grocery registered a year-over-year growth of over 50%, and the subsidiary's next day delivery is now available in over 200 Indian cities. Flipkart in August also successfully launched its quick commerce space business called Minutes, thereby entering a segment that is expected to grow at a CAGR of 24.33% over the next 5 years. Ladies and gentlemen, I will most certainly be dedicating a Doctor Goes Home segment to quick commerce space. I've invested in Zomato, which actually owns Blinkit, a major quick commerce player. Honestly, quick commerce is has app has I have no words for how much this has surprised me in a positive way. I mean, this has been. I mean, I was in India last month. We were traveling. We got home in the evening normally, and we didn't have groceries. And I just could see my mom go to Swiggy, who's also going on IPO, another segment dedicated. And she just basically took on, Instamart, which is quick commerce for Swiggy's quick commerce business. You know, whatever she needed or placed the order in about 8 minutes. It's at home, and I'm talking about at 8:30 p.m. I mean, it's blown my mind away. It's fantastic. I know it's not a big deal for my Indian listeners. They would be probably, you guys probably would be laughing at me right now, but honestly, I don't see that here. In England, I don't see that here. They say it takes up to 2 hours to 1 day, 24 hours. Quick commerce is insane. I'm definitely sold on it. I've already invested in Zomato. I'll most probably be investing in Swiggy's IPO as well. More on that later. But what I'm trying to say is this thing is an absolute game changer, and it just goes to show the technological advancements, especially from a consumer perspective, made that is being currently that is undergone that is currently being currently that we're witnessing in India, if I might say so. So yeah, just coming back to it, minutes is what Flipkart's quick commerce is, and this is a segment that's expected to grow at a CAGR of 24.3%. So the Walmart is benefiting from this quick commerce explosion. Although Minutes is only available in one Indian city today, Flipkart has concrete plans to scrape up the business in time for the country's busy festive season. More specifically, it plans to operate around 100 dark stores, which are mini warehouses for its quick commerce business before the festive season. While Minutes is a long way to go before it can compete with the already established players such as Zepto and Blinkit and Instamart, the growth of Flipkart in recent times, as well as the subsidiaries' improving contribution margins, would provide a strong foundation for the growth of Minutes in the coming months. All things considered, Walmart's international business proved to be a valuable sidekick to the US business for yet another quarter, and the segment, in my opinion, has the strength to support the company's US business, especially in the event of a potential slowdown or recession in the US. Finally, as far as takeaways go, before I move into valuation, I want to talk about the strong growth that Walmart's membership program is delivering. In the most recent quarter, membership-related income grew 14.4% year over year. New records were set in both in terms of total memberships and Walmart Plus penetration during the quarter. Memberships, together with advertising, were also responsible for more than half of the company's second quarter operating income growth. A key pattern that occurred within membership segment was a shift in the demographics of new members. More specifically, the company's Sam's Club segment saw Gen Z and millennials accounting for 50% of the new members in Q2. From a future growth perspective, this bodes well for the company, as onboarding a younger demographic, one who tend to retain their memberships, could shop at the company for probably decades to come. I mean, it's fantastic. It's the pivot by Walmart in terms of memberships. It's great. Now, let's talk valuation now. And here's what I'm going to do, because there's a video here. You guys can catch this on YouTube. My goofiness comes alive. I'm going to show you some numbers. Yeah, so I've got my book here so that you can all figure out. Let me find a blank page. What is it? Am I running out of page here? There we go. Right. So, as per the most recent quarter, Walmart has forecast adjusted EPS to be anywhere between $2.35 and $2.43. I'm writing this as we speak, guys. As management has not seen any waning demand, and since deploying generative AI has led to improved user experience, I've assumed the higher end of the updated guidance, so 243 for my calculations. So adjusted EPS forecast is 243. Can you guys see this? Of course not. Use a pen. There we go. Adjusted EPS, $2.43. Okay, this is my EPS forecast. Okay, much better. So EPS $2.43. Okay. According to LSEG data, Walmart currently trades at a forward PE of 28.4x, above its 5-year median multiple of 23.2. However, relative to its peer Costco, which trades at a forward price to earnings of 49, the stock is cheap. While Costco has always traded at a higher PE multiple than Walmart, the consistent growth shown by Walmart, especially in a challenging environment, I believe that Walmart deserves a higher multiple than where it's traded historically. Therefore, I have assumed the current forward PE of 28.4 for my calculations, marginally higher than my previous assumption of 26. So, I have assumed 28.4. I'm going to show you the math. According to Seeking Alpha, Walmart's forward price to earnings to growth ratio stands at 3.42, which is close to its historical average of 3.67. If I assume 3.42 and a forward PE multiple of 28.4, we get a growth rate of 8.3%, which is in line with the company's long-term average EPS growth. I believe that this is a more reasonable growth estimate compared to my previous assumption of 11.2, since the macro backdrop has considerably weakened since the last time I talked about Walmart. As such, I've assumed FY26 EPS to grow at 8.3%, which translates to $2.63, marginally below my previous estimate of 264. So 28.4, I know it's reverse, multiplied by 2.63. Okay, so forward price to earnings multiple of 28.4, and I've got an earnings estimate of $2.63, will give you $75 price target. 75 price target, not 57, $75 a price target. It's about 7% lower than where it's currently trading at. He says as he throws away the book. It's actually, Walmart is currently trading at an all-time high of 81.11. Okay, the stock has been up more than 15% in the last 3 months. So this little to no upside should not be surprising. Having said that, the stock has an A-grade multiple on Seeking Alpha's momentum scale, so I can imagine the stock continuing to scale new all-time highs for the foreseeable future. From the fundamental perspective, however, I don't see any upside. 75 is the price target, so I continue to have a hold rating on the stock. There you go. I said it. This time you see, with even though the math is a bit of reverse, you at least see 28.4, 2.63, price target 75, sorry. Bottom line, it was yet another goofiness almost coming to an end, ladies and gentlemen. It was yet another strong quarterly performance from Walmart. Both revenues and EPS beat analyst estimates, and the management also raised their full-year guidance. Gen AI has really been a blessing for the company, especially for its e-commerce segment. The international business, driven by the likes of Flipkart and Walmex, continues to be strong and complements the company's US business. The increase in memberships among the Gen Z and millennials also bodes well for the company's future growth. The stock does have strong momentum in the near term. However, on the valuation front, I simply don't see any upside at current levels. In fact, I only see downside, but not much of a downside. It's pretty much fairly valued, I would say, at the current levels. I do continue to like the company, and should we get any sort of meaningful pullback in the stock, by the way, which is a possibility, if the US economic conditions improve, remember, there could be a pivot back to the high growth names, and Walmart could see some selling. Walmart, remember, is a defensive name. So we could get some meaningful pullback now, even though the Seeking Alpha momentum scale says A grade. If should we get a meaningful pullback in the stock, then this is one evergreen name that I would be more than comfortable having in my portfolio. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. Once again, thank you so much for all the love and support. You now can get to see my goofiness in real time, as the video version of the podcast also goes live on YouTube. So thank you very much for all the love and support. Please continue supporting me. I really enjoy making these episodes for you, so I will continue to do so. I really hope you've enjoyed episode 101. Thank you once again. I will see you next week for episode 102. Until then, stay safe and make some money.